Hi, Matt McAleer, Director of Equity Strategies, October 2nd. This week gave us a great follow-up to last Friday's video. Last Friday we spoke about the difference between volatility and risk. Headlines create volatility. Structural damage creates risk. We saw a couple of episodes this week. Post-debate, futures were down hard in the morning, recovered nicely. COVID-19 positive for President Trump Thursday evening. Futures down hard. Here, mid-afternoon on Friday, there's been a bid that has snuck back into the market. We've also had unemployment numbers and things of that come up this week. Remember, headlines. Keep an eye on the reaction of equities underneath that. People are looking day to day, week to week, month to month on how our economy is recovering from COVID. Well, the last 30 days, if we're taking a look at the equity market, have to be impressed. Where are your leaders? What are the leaders trying to tell us? Packaging, logistics, trucking, shipping. Very heavy, very strong areas of cyclical economic growth. Very positive to see as not just an investor or a trader, but as a citizen. We want to see a return to some of those robust numbers we saw in the fall and in January, where unemployment was at record lows. Some of these names that we need to keep an eye on are giving us very positive readings. Overall, index is very solid this week, even with some of the weakness here on Friday. Very solid from tech, very solid from large cap, right through mid cap, a little bit in small cap. Love that breadth. Look at the Russell 2000, positive today on a day when the S&P is down. Important to recognize that. Is it a one-day, two-day event? Let's see. Nice to see that interest rates have leveled off. While they haven't leveled off at a rate that we're excited about as investors, the fact that they've stopped going down does give us a bit of a barometer that perhaps things are better than what the headlines are telling us. Our action this week in our portfolios was muted. No buys, no sells. We like what we own. Our latest buy was last week in tactical trend, Alibaba, solid week. Have a great weekend. See you next Friday.
Hi, it's John Mousseau. I am the President and CEO of Cumberland Advisors and Director of Fixed Income. It is Friday afternoon, October 2nd, a day where we learned that the President and the First Lady did contract coronavirus. Interesting, the markets today kind of moved in tandem. Yields were down with concern over this. As we found out they had a mild form of this, they came back up a little bit. Same thing with the stock market, which went down and then came back, as you heard from my colleague Matt. I think what you look at this week is a 10-year government bond, which basically moved from 0.66 to 0.69. A 30-year government bond, which moved from 141 to 148, up about 7 basis points. Municipal yields about 15 basis points higher than those Treasury yields. But more importantly, it really marked a month where a very tight trading range in September. The 10-year government bond moved from 0.65 to 0.72, and back and forth, never breaking outside of that. In other words, volatility in the bond market, very low. Backdrop to this, continued improvement. We saw unemployment dip below 8% today. We saw initial jobless claims yesterday, a little lower than expected. Job creation today, also a little lower than expected. But in general, moving forward, we think that you're starting to move towards some normalcy. We've seen corporations start to buy back debt that was issued back in the spring when things were a mess. That is a very good sign. Again, moving more towards some normalcy. We think as you get closer to the election, what happens? You start to remove some degrees of uncertainty that have been keeping yield volatilities low in general. Those things are certainly related to coming out of the virus economy, number one. Two, a vaccine and its efficacy when we ever get it, number two. The election, clearly number 3. And we think that the removal of the uncertainty once you get to the election takes one of those key uncertainty items off the table. And what it means is that you probably start to see yields rise. We think you're starting to see that now a little bit. Remember, one of our basic tenets is that yields should start to rise to a point where they're at least matching the rate of inflation. It has been under the rate of inflation for a long period of time. It could stay this way for a while, but eventually either inflation rolls over and plays dead totally, which it's not doing, or yields start to rise as economic activity picks up. We think that's the more normal course of affairs, though it will take a while. We're starting to see municipal supply pick up on the tax-free side. We've talked about that. Yields are back to where they were basically at the end of February. So that's certainly a green light for issuers to try to come to market. We have seen that. We did see municipal outflows this week in the bond funds, first time in 20 weeks. We'll watch that. 1 week does not make a sign, but it tells you that people are looking for some alternatives to the fairly low yields that we have there. So it's not quite a buyer's strike, but clearly municipal yields are low. So it's in favor of the issuers. It's not really in favor of the investors. It's one of the reasons why at Cumberland we have started to play defense a few weeks ago in bond portfolios. So with that, we grant you a very nice weekend. We hope the President and the First Lady recover quickly, and we'll see you next week. Thanks a lot.